Welcome to the Explainer. Today, we're opening up a completely fascinating financial case file on a company you definitely know from the grocery aisle, but maybe not from the trading floor. I'm talking about Cal-Maine Foods. We're going to strip away all the usual market noise and look strictly at their raw data to see if we can uncover a hidden bargain. The goal here, to piece together the real, unfiltered story this balance sheet is trying to tell us. Okay, let's dive into this. Look at this number. 4,034.79%. That is Cal-Maine's total return over the last 20 years. If you held this stock over the last 2 decades, you literally experienced the kind of explosive, market-crushing compounding that, honestly, most investors spend their entire lives chasing. It is just a staggering historical performance. But here's the absolute kicker. They pulled off that monumental growth with this number right here, 0. Absolutely 0 debt to equity. Think about that for a second. In an era where corporate growth is almost always fueled by massive borrowing and leverage, Cal-Maine has managed to relentlessly compound wealth for its shareholders over the long haul without taking on a single cent of long-term debt relative to their equity. It's wild. Which brings us to the core mystery we're trying to solve today. How does a company with this kind of stellar historical performance, a proven compounding track record, and a literally immaculate zero debt balance sheet end up trading at a price-to-earnings ratio of just 5.41 today? Normally, a PE that low screams deep distress, but the historical data screams powerhouse. So yeah, something here really doesn't add up. Let's start peeling back the onion with layer 1, the long-term growth story. When you check out the 3-year, 5-year, 10, and 20-year returns, it's a consistent history of value creation. 168% over 5 years? Fantastic! But look over to the left at the trailing 12 months, that immediate past year, a drop of almost 16%. So while the long-term trend is a straight-up rocket ship, the stock has clearly slammed into a brick wall recently. And when we zoom in on that recent trailing 12-month period, well, the data is undeniably harsh. Revenue is down nearly 9%, net income contracted by about 30%, but the real shocker is right at the bottom. Earnings per share, or EPS, has plummeted by almost 90%. Ouch. This incredibly sharp contraction in earnings over the last year is exactly what's dragging the stock price down and compressing that PE ratio. The market is just reacting to this immediate acute pain. So this is the major pivot point for us. We see the recent pain, obviously, but we have to ask, is this an unrecoverable, permanent, fundamental breakdown of their business model? Or is this just a temporary speed bump for an otherwise healthy operation? To answer that, we've got to look past the stock price and pop the hood on the actual business engine, which takes us right into layer 2, operational health and efficiency. Okay, so despite those recent price dips and that brutal earnings contraction we just looked at, the underlying business is still highly lucrative. A return on equity over 25% and a return on assets over 22%. That shows they are incredibly efficient at wringing profit out of the resources. Add in a net profit margin sitting at a super healthy 26.2%. Guys, these are not the metrics of a dying business. This is a company still generating very serious cash. And honestly, it gets even better when we look at their capital allocation. Check out their return on invested capital, ROIC, sitting at 35.75%. Now, as you probably know, in the finance world, anything over 15% is usually the mark of a truly great business with a wide competitive moat. So hitting nearly 36%, that means management is exceptionally good at taking the capital they have and turning it into even more profit. The internal engine is just incredibly optimized. Now, layer those massive profits on top of their liquidity. A current ratio of 8.21. That means for every single dollar of short-term liabilities they owe, they've got over $8 in cash and liquid assets sitting there ready to cover it. Even the stricter quick ratio is at 6.58. When you pair this vast liquidity with the fact that they have 0 long-term debt, you are looking at a balance sheet that is virtually bulletproof against short-term economic shocks. So we've clearly got a disconnect here. On one side, dropping earnings and a falling stock price. On the other side, a structurally sound, highly profitable cash machine with a fortress balance sheet. Which really begs the question, considering all of this, is the stock actually cheap right now, or is it just fairly priced for a tough environment? Let's find out in Layer 3, dissecting the valuation ratios. Now, what's really interesting about this slide is the sheer magnitude of the discount compared to the company's own historical baselines. That PE ratio of 5.41, that is a staggering 83% lower than its 5-year average. And the EV to EBITDA ratio, which tells us the total value against core operating earnings, is sitting at just 2.65. That's nearly a 64% discount from the norm. Across the board, these multiples are screaming that the market has aggressively priced in an absolute worst-case scenario. And because the market has punished the price so severely, the yields are now exceptional. Against a roughly $3.67 billion market cap, we're looking at a free cash flow yield of almost 20% and an earnings yield close to 19%. Translation? The company is practically gushing free cash relative to what it would actually cost you to buy the whole business today. Which brings us to the climax of our investigation, the reveal: fair value and safety. When you take all these operational metrics and free cash flows and plug them into a standard discounted cash flow model, to mathematically estimate the present value of future cash, the result is honestly eye-opening. Against a last close price of $77.61, the math points to a fair intrinsic value of $176.67. Let that sink in for a second. According to the DCF model, this stock should actually be worth more than double its current trading price. And that gives us a 56.07% margin of safety. In value investing, this margin is your ultimate safety net against being wrong. Even if our intrinsic value calculations are a bit off, buying in at such a steep discount gives you a massive built-in cushion against future volatility or errors in estimation. So we've reviewed the file. Yes, a recent severe dip in earnings drove the valuation down to historic lows. But underneath that temporary pain is a zero-debt, highly liquid, highly profitable engine that our intrinsic value models suggest is deeply mispriced. It leaves us with one incredibly provocative thought to wrap up on. With a 56% margin of safety and a practically bulletproof balance sheet, are you looking at the market's best-kept secret hiding right in plain sight? Take a look at the data and decide for yourself. Thanks for joining me on this explainer. I'll catch you next time.